Over the past few weeks, we've seen a huge move from Wall Street, with markets moving out of tech stocks and, of course, into other asset classes. But what does this actually mean for us as traders and investors? And more importantly, are we seeing signs of distress in the US economy and many bonds around the world? In today's video of the Pepperstone's Macro Edge, we're going to take a look at everything that you need to know right now about markets, and there's a lot to discuss. We'll see you very soon. Well, welcome back everyone to Pepperstone's Macro Edge. My name's Thomas Atkinson, and today we're going to be taking a look at what's going on right now underneath the hood when it comes to markets in the US and around the world. We'll start off by going through the macro, then we'll look at some charts, and of course, we have a lot to bring you today. So let's get stuck into it straight away with some great charts coming from several different sources. First up, I like this one here from Deidre Bosa. Basically, it shows software versus the NASDAQ, which has historically shown incredible correlation up until the point of around 2025. And basically the advent of potentially AI starting to take over in this particular field, allowing people to, of course, start up new software companies and potentially compete with the biggest guys. It's similar to what we saw during the tech boom. But is this actually a problem? Obviously, it is a huge divergence, and you can see here that software has become one of the most sold sectors in the market. But it does also tell a tale about the AI and, more importantly, the unemployment potentially figures coming out in 2026. And just over the last week, we found out that they were revised down big time when it came to 2025, down well over 700,000 when it comes to the overall revisions. We actually saw a US economy that might be showing signs of incredible weakness, and it's leading into, at least in terms of the unemployment, and it's leading into, of course, some big moves in the yields. Let's have a look then at what retail traders tend to be doing, and of course what Wall Street might be doing to counteract some of these trades. First up, retail imbalance. According to the latest study here from source JP Morgan and bar chart over on X, you guys can see that this is huge right now. Retail traders are getting more active in the markets, and I'm sure a lot of us are very interested in the current volatility, and that has hit a new high. Now, this is data taken from the 4th of Feb, and it actually shows that it's at the 99.7th percentile. And this is a pretty big deal because it basically shows that everybody is becoming excited, and more importantly, that this is one of those times where there's abundance, but also there could be FOMO in many different sectors. For 2026, things are a little bit different. According to Carson Research and Gilbert 3142, you guys can see here that this is a market that is very different from any previous one. Basically, energy sector, materials, something we've been talking about here on Pepperstone's Macro Edge, gold, they've been the best of the year so far, and we've seen other markets not doing so well, including financial sector, which is actually down the most in terms of any of the major sectors this year. And that kind of shows us that we might be leading into what we call a later cycle in the markets, where people look at hard assets and some other things similar to that. The market stats over on X also showed something similar, with more stocks making new highs, but also more making new lows, and this becoming a huge distraction from the markets. Basically, the breadth is improving, but big tech is going down. And as we know, the big tech is concentrated at around 37% of the market. So, of course, we may see some potential declines leading into all of this over the next couple of weeks based on those stats alone. You can see here that the percentage of stocks hitting 52-week highs according to the market stats sits around 20%, and the percentage hitting 52-week lows at the same time is 6.3%, and both are actually accelerating, a very unusual trend that we often don't see in markets, and it's kind of making the S&P stay in a range-bound area, which we'll look at soon. To make matters even more strange, we've also seen Wall Street favor defensive assets, utility stocks, staple stocks. All of these have been going up over the recent weeks, including telecommunications. And it's leading to, of course, this type of stat, which basically means that we've got a little bit of an overbuy now in the staples market. And a lot of people are wondering whether this means big tech is about to find its base soon. With all of the big Mag 7 actually down on the year at the time of this recording, according to Y charts here, you guys can see that there's clearly a big kind of differentiation. And more importantly, we need to now look at the charts to see what exactly is going on underneath the hood. We're also seeing some signs of distress in the US market. Of course, student loans forgiveness has now been turned off, and you can see that we have many delinquencies past 90 days. And we also have here, of course, some big movements, including some huge movements here in mortgage sector, with slight upticks in both that and, of course, credit card delinquencies over the next couple of months. It's something we're going to have to be watching. Now for a stat that I think is pretty surprising. This one's from Seth ZCL over on X, and you can see it's got to do with midterm election years. Now, we're not quite at the midterms yet, but many of you guys would be aware midterm election years tend to be really volatile. And you can see here that after the midterm election year, so basically as of the midterms, if you'd bought the market during those times, they actually had pretty strong results up to 30th of June the next year. So it's a really interesting stat here, and I think it's one of those ones that you might want to think about into the future as we see this year unfold. Often volatility leading into the midterms is what people look for, and then after that, maybe we get some form of stability. Though 2026 could, of course, do anything. In terms of Nautilus, you can see here the overall bull-bear spread is starting to move a little bit with a small cross, and often these inflection points have been kind of periods of consolidation or even dip buys for markets, and this is kind of the type of thing that you look for a peak point of potential consolidation, or usually during the dip. In this case, it could mean consolidation. Of course, we've seen the charts and what they're doing right now. Now, all of this kind of points towards a few things. One, we've seen credit spreads go up in terms of big tech stocks, led by Oracle and, of course, its funding of AI data centers and everything going on with that. But we're also seeing a second story, and this one here is from Bloomberg, and you can see that it shows that the dollar's role in global reserves is now withering away. So basically gold, which everyone's talking about during 2026, has overtaken the US dollar as the hedge of the world in many ways in terms of the most important currency. And this really marks a big factor, as if you go back through history and you actually look in the 1970s, I think it is, in those periods there, we're actually seeing usually gold above the dollar. But for the last kind of 10, 20 years, it's been all about the dollar versus gold, as in the dollar's been stronger. This doesn't exist as a new trend, but it is one to watch over the next couple of years. So let's jump into the charts, and first up, we'll have a look here at the S&P 500, and what we've put on the bottom is an advanced decline line. So basically, we are seeing more stocks advance than decline while the market stays range bound. And the reason why this is happening is when we take a look at the Magnificent Seven. So if we put the Magnificent Seven on the charts, it's pretty clear that the Mags is going down, and from a technical perspective is actually broken down in the markets. And this is a fairly big deal because, of course, this is leading to some concerns over what's really going on in these markets and whether they can hold up if the other stocks start to fall as well. It's not a sell everything market. It just seems to be weakness in tech overall. Another one that we showed today was, of course, the software sector. And you can see the software sector has come down to a pretty important demand zone. And activity has, of course, started to increase with the volume going up big time as people kind of sell and people obviously buy. So there's clearly two opinions here on software. It'd be interesting to know your opinions down below on what you're thinking about the software sector, as of course it's come under a lot of pressure due to AI. In terms of some other reads that we've talked about here in the macro show, we also have the American consumer discretionary versus staples, and that's dropped off a little bit in recent times. And this is basically showing that we have a market that is starting to weaken again from the American consumer. Remember, 1/3 of the US economy is the American consumer, and this is, of course, having an effect. So what does all of this mean when it comes to markets around the world? Well, the most important thing for us to watch right now is the evolving story of course, how AI is impacting on jobs. And because we know the revisions so far have been quite bad for the last 2 years, it's clearly having an impact on the US economy. It's falling down when it comes to yields, and this is suggesting that there could be more cuts over the next 12 months, something that we need to watch along with strength in different sectors. You can see here the utility sector, staple sector, and all of those have been going up. But the real question comes back to tech. If we lose what was the backbone of the market, particularly semiconductors, things could start to look a bit shaky fairly quickly. And one of the most important levels is going to be 24,000. So, in terms of the macro world right now, there's a lot going on, but the key is that we haven't actually broken down these trends other than the Magnificent Seven just yet. It's a story that's going to be evolving, and of course, if you enjoy today's video, make sure to subscribe to Pepperstone's Macro Edge, and we'll see you in the next one when we come back in 2 weeks to discuss everything that's going on. Thanks so much, guys, and we'll see you in the next one. Bye for now.